Welcome to the Foundation for the Study of Cycles. My name is Lars von Thienen. I'm a member of the board. Once a week, every Monday, we meet here to analyze some cycles. So, thanks for joining me today. We are live today, so I will have a look at the chat section on the left hand here on my screen, so you know if I move my head this way, I have a view on the live comments. So feel free to drop in your comments. Latest at the end of this session, I will look at these topics and you have the chance to receive some live answers and discuss some topics during the session. So what are we doing today? I have prepared at least a special topic I want to talk about, and this topic is about combining the work of Peter Eliades, who is kind of rock star in the cycle analysis community. I'm sure you will know about his work and his stock market cycles report. He was also part of our summit last year. And he did a public video last week, which I want to discuss with you with some important cycle analysis. And the key topic for today is I want to combine digital signal processing, as we are doing with our application from the foundation, where we apply Fourier analysis, digital signal processing to detect the timings, the timing of dominant cycles, and make projection based on these timings. And that's an important topic, to combine with his work, which is also derived from Hurst and the nominal cycle model. But, and that's important, Peter Eliades is more looking for price projections based on the nominal cycles model, which he transferred into his projecting and forecasting services. And now, if both methods, which originally are based on cycles, are just with a slight a tweak here and there, so the one more looking on timing and digital signal processing, the other one more looking on price projections based on a nominal cycle model and the right offsets. So, and I think it's interesting if both approaches more or less come into alignment. I think that's a very interesting point in time, which we have right now. So we have a very important time in regards to cycle analysis and the global financial markets. This is the topic I want to talk with you today, and this is the only topic, because there's a lot of topics for you to follow up. I will pinpoint you to the other content you should look up or can dive into after the session. Enough for the intro. That's the topic for today. So we will keep 20 to 30 minutes, and I will try to make the point why we have an important market juncture in regards to timing, digital signal processing, and cyclic price projections based on the work of Peter Eliades. Okay, let's get into it. For the people who are not familiar with the work of Peter Eliades, which I don't think so, because you must know him. If not, at least now it's the time to get aligned with his work. So let's get into the studio now. So here you see his homepage. Feel free to reach out, stockmarketcycles.com. It's just the website about Peter, as he was part of our Cycles Summit last year. He is in this area much more longer than me. So I think over 40, 50 years in the stock market and cycle analysis. So he really knows what works. And his work is based on the early days of Hurst nominal cycle model. So he's more or less a follower of the basic principle which Hurst laid out in the early days of the foundation. But he has developed his work much more further. And the key point is that he now has developed a model which he is using regularly for his updates, which is based on cyclic price projections. He is doing regular updates on his YouTube channel, so you can reach out and get into these topics. He's offering a lot of content, and he has a free YouTube channel with some more important updates. And that's the topic or the point I want to talk to you today on this topic here, because if you see the date of this video, right, it's about November 17th. So last week, he did an important update about stock market cycles. Yeah, and you need to watch it. If you're really interested in cycles, I make you aware of this video. I will post the link here down in the comments just in a minute. And you know that he is a cycles crack, rock star, a genius, however you want to call it. So it's always worth to follow his analysis. The key point he is making right now, or in the current days, about the global markets or the S&P 500 or the main markets in general. You see this here in the upper right corner of these charts. The key method he is using based on the Hurst nominal model is to derive price projections. So where the next turn based on cycles could be expected in regards to the price projection. Right? And that's important to keep in mind. And the numbers are here on the chart. And if you watch this video, you will get aware of these price projections. And we are very, very close right now to these price projections in the S&P 500, in the Nasdaq, and in the cash indices. And these price projections he is outlining based on the work of Hurst and his further algorithm using the nominal model and the offset calculation, and then doing the projections based on this method. All markets are close to these price projections right now. And if you listen closely to his analysis, this is not just a price projection. This is, following his work, the price projection we should remember maybe a long time moving into the future. So this is a very important cyclic price projection based on the work of Hurst, further developed by Peter Eliades with his great work on doing these price projections. We are close at. So head to this video, watch his work, and now we see a price projection based on cyclic analysis. And why is this important here for us today? Because you remember what we are doing here on the channel is mainly digital signal processing, right? So Peter Eliades is not interested in the current timing. So he uses the nominal cycles model of Hurst. So the 10 days, 20 days, 20 weeks nominal model, and then is finding the offsets based on price movements in the market. So then he uses the movements, the offsets, and then he uses the price projection based on the current cycle. We are analyzing or fine-tuning the current cycle length based on digital signal processing. And as we do it normally, we are not interested in the Hurst nominal cycles model. There's a way to filter only detected cycles in the Hurst nominal model, but I'm not going into this route today. The core idea of digital signal processing is detecting the cycles which are active in the data series. So we pick the cycles based on digital signal processing, which could be detected in the data set we are pushing into the framework, so Fourier analysis and the special processing we use here. So, and the outcome of our analysis, is about timing and not price projections. And that's the interesting point. So if we now move over to our cycle analysis, which I will now show up here, and I will update the current markets based on this idea, this gives us timing information. And I always tell that the amplitude we see on these cycles is not as important. So we don't follow the amplitude of these cycles for price projections. We just follow the turns of the composite or the cycles we select to derive the correct timing point based on cycles, right? So, and I will update you in a second. So we have now two things we can combine. We have current cyclic price projections based on the model of Peter Eliades. Please watch the video. And we now add cycle time projection based on digital signal processing. And the key message, if you don't want to watch the full analysis, is that the time cycle projections based on digital signal analysis are getting to the same conclusion as Peter Eliades did based on his price cycles, right? So the time projections tell us the same story, that we are at a very critical point in time right now. So during these weeks and these days, we expect a major market turn based on timing. So let's update this cycle analysis now for a second. So let's start with the weekly chart. As I said, on the daily series, we don't have clear signals, or at least diverging signals during the past weeks. So we, again, open our weekly charts on the S&P 500, which is listed here. So let's start with the plain analysis so that everyone is able to follow. This is the weekly long-term chart going back to 1995. So we have 25 years of data, which we push into our digital signal processing. And let's see what the weekly dominant cycles are in this case here. So the interesting point is when we look at the spectrum, which we do here, we have two peaks which stand out in the spectrum. This is how we do cycle detection with digital signal processing. You look for the peaks in the spectrums. So this is a very, very objective analysis here. So this one here with the length of 180 weeks will be selected. And the second peak is visible here at this point in time with the length of 388 weeks. By the way, there is a harmonic relation between these two cycles. So that's the second argument to pick these two cycles here for our projection. 188 weeks, 388 weeks, close to a harmonic of 2, which also makes sense. We have a good Bartle score, and both have high strength score according to our framework to select these cycles here. So we go up to the list here in the upper right. We select the cycles with a length of 180 weeks. I will zoom in a little bit here to make this more clear. So this is just purely based on this one cycle, and then I will add the second cycle, which is here in the list with a length of 388 weeks, not days, calendar weeks. And I will now build this composite cycle projection based on these two dominant cycles. Before we look into the future of this projection, when you do these kind of projections, you need to have a closer look on the historical analysis of these cycles here. So, and as said, don't pay too much attention to the amplitude change. It's about the turns of this composite in regards to the correct timing we are looking for, right? So therefore, I will just cross-check very easy the timing of this composite cycle, which you see here. So here's the top in the composite cycle, exactly aligned with the market top in the year of 2000. And then the major low was projected by this composite exactly here in the year of 2002. Exactly in alignment with the major market low at this point in time here. So then we see that the composite cycle top was projected here, the year of 2007. Also very close aligned with the major market top here, and then the composite low here in 2009. The real low was coming in more early that year, and then the next upturn here into the year of 2014, exactly with this market top here. And I explained this in a previous video. Then we saw this time here until this point in time here is more or less, it's not a downturn, but on average it was more or less a sideways move. And then the next big upswing started here in the year of 2019. So you can point this in between these two major lows here. So on average, it's quite good, the low here. So this predicted a major long upswing here, which then got into play in the markets. And you see now where we are. So in regards to the mathematics here of this analysis, you see the composite score here, which is green. So the overall correlation of these long-term cycles have a score of 0.8, which is a very positive correlation of just these two cycles with 15 years of market data. It's a very high correlation. So that's good. So we know that these two cycles have very high correlation to the last 15 years. just in regards to timing, not price projections. And now, it's more what we did sometimes here on this channel is you see where we are in this cycle here. So this cycle now reached a major important top. Yeah, so the top started already in September. So when the first top in the market arrived, this is where this cycle topped. We now saw an extension here of the daily market during the last 2 months, or just after a short move here. But we are still in the major topping window of this composite cycle. So this cycle has not rolled over, or market has not proven that the cycle is wrong. So we must pay attention to this long-term cycle, which is still signaling a major important topping period in regards to timing right now. So we don't know where the price might move further to the upside until the markets might turn. But if you listen now to Peter Eliades, he has price projections for you. And this is the killer now in cycles. If time projections and price projections come into alignment, we need to monitor what happens in the markets. But that's the long-term perspective, right? So we need to now switch to shorter-term cycles. So the daily cycles require also our attention. So now from the weekly S&P 500, let's add some sentiment data first. So before we switch to the daily cycles, there is the Financial Stress Index, which is published by the Federal Reserve Bank of St. Louis. So this is the public available index. It measures the stress in the financial markets. It's a long time data series, which is updated once a week. Let's add here some more data into the past for our cycle analysis. So similar period here, so that we have back to 1997, 25 years of data. And let's check where's the peak in the spectrum. We have this 197 weeks cycle, which is, if we talk about nominal cycles, it's quite similar to the 188-week cycle. So in the financial stress, it's visible via the 197-week cycle. So let's add this cycle here on top of the data set. And you see how nice this cycle, again, is aligned with past tops and bottoms of the financial stress. Don't pay too much attention to the amplitude, but this top here is exactly the top in the financial stress index here. Same with the lows in the top. And again, it's a complete different raw data set here. And you see the current projection. We are at a financial stress major low from long-term analysis. And you need to read them vice versa. So a low in the financial stress index always correlates to market tops and vice versa. So in addition to the weekly analysis of the main markets, this is confirmed by the weekly analysis of the financial stress index, also from a timing perspective, signaling that we are in a key bottoming from the financial stress or vice versa, a topping a market situation here. So the weekly data sets, financial stress and global markets are in alignment. So now let's switch to the daily analysis of these markets. There it gets a little bit tricky because the short-term analysis, or during the last months, this daily cycle was not in sync. But what now happens is that we can put the daily analysis, which we do now on the S&P, put into perspective of the weekly analysis, right? So therefore, let's move to the weekly series. So here we see the S&P 500. Now we see here the top September, then the short downturn and the next upswing here. And this is the full year, which is just a linear upturn. So we need to add more data for our data analysis instead of just using the upswing here. So let's load some more data here for our analysis, at least going back to somewhere here. So we have more long-term analysis. Also, again, now here we are using 6 years of daily data. So at least we have the last 6 years to see where the peaks in the spectrum are. And here again, this is what we are looking for. Clear peaks in this spectrum, right? So just to make this visible for everyone, here we have a clear peak in the spectrum with the length of 170 days in this case. Now here we're talking about days. So this is the first cycle which is standing out here. And I would not pay too much attention to the shorter term cycles, which have at least red triangles, which means they have a very low Bartle score, or smaller triangles, which means they have a very low strength in regards to our digital signal processing. So this is a green triangle, a big triangle, which means good strengths, good Bartles, and a clear peak in the amplitude spectrum. And then the second one here shows up at the length of 370 something. Again, we could argue it's kind of harmonic relation between these two cycles here in regards to their length. Not exactly, but close to a relation of 2, which is, according to Hurst, a harmonic relation. We should pay attention because the ratio of 2 is always important, and a very high Bartle score. So that's the key digital signal processing we are using here for our analysis. So let's add these two daily cycles in our mix here. So the first one has a length of 170. And if you did your homework, as I said, you need to do the cycle analysis regularly, day by day. Never go to a chart, just to one cycle analysis and then trust the analysis. You need to have a feeling of this market, which cycles have been active in the past and which not. So cycles which have been active in the past show up again. This makes your analysis more and more reliable or trustworthy. The cycle of 170 is visible since the last 2 years. However, you see during this and it projected here somewhere the top in the summer of 2000. I mean, we had a phase shift, so we need to go back, or we can go back here for a second, and the low here in March, but then it went off, but at least it was anyhow just a straight up move here, just a straight line up. So there's no cyclic behavior. So the dominant cycle of 170 was just purely ignored. Or we could say that the market never consists only out of cycles. So there is a longer trend in play, or even a larger weekly cycle, which we saw, which is now coming into alignment. So during a strong uptrend, and the weekly cycle was still pointing up, which is now coming to an end. So now we sync the weekly cycle, the trend, and the major short-term cycles, which is still there, the 170, but, and that's important now for where we are in the current reading, I will zoom in a little bit, just based on this cycle here, this projects from a timing perspective that this could lead into December. So maybe from a daily perspective, we have a leeway into December before this cycle seems to top. But that's just the fine-tuning. I mean, the weekly cycles have already topped, so maybe we need to wait until the dominant daily cycles get into alignment, which seems to happen somewhere in December. So we can add the longer-term cycle with the length of 372 also here into the mix. Again, don't pay attention to the amplitude. So we need to have a look for the major top to come, which is then the 1st of January. So by the way, what is very, very interesting here, so that this cycle combination of two dominant cycles here exactly projected at least this bottom here, which happened at end of September. So, and then we need to wait until this loop or upswing will come to an end latest somewhere in December, right? So we are, according to these dominant daily cycles, we are in a shorter upswing cycle here, which should end somewhere in December, you know? And then all cycles are into alignment. The dominant cycle model of the daily series comes into alignment with the key top December. the weekly cycles on the global markets and the weekly cycles on the financial stress index. You can, and just for fun, because I told you, if you're new to this channel here, that the cycles with the length of 170 was active in the past. So just for fun, and this is what you can do if you have these kind of tools here. Let's go somewhere to a point in January, February of the year of 2020, before the COVID crisis arrived here in our Western world and everything was okay, the markets went up. So somewhere here in this time. So I will set the end point of our analysis right at this point here, update the analysis. So the light blue data, what you see here on the screen now, is out of sample, is not known by the algorithm. So just the dark blue data, what you see here, is taking into account for our digital signal processing. And now you can maybe think about why I'm emphasizing the cycle with a length of 170. Because if you look into the spectrum here, yeah, you see that we had a very clear peak in the spectrum in February of the year of 2020 with a length of 173 days. So that's the reason why I always repeated that the cycle with a length of 170 something was anyhow important in the past. And you know, it has been detected also today, right? So this is a real active cycle in the market. And if, I mean, I can even hide this data set. So this is how it would look like at this point in time. Yeah. So, and if I now overlay the 173 days cycle at this point in time, we have been warned in February of the year of 2020 that we should expect, from a timing perspective, a major high in the markets. Yeah, with a downswing into May. Yeah, and I will now add the data. This is what happened. Yeah. So this downswing was projected by the 170-day cycle. That's the reason why I just repeat why the cycle is important. And as you know, cycles are never static, so you need to update your analysis from time to time. So let's, just for fun, last point here. So, and here you see we even overshoot this topping point here a little bit. And this is also quite happening or normal in financial markets, because they are not, the cyclic movement is not even. So the period a market moves up is now extended during the last years. So up runs are smoother and longer, and downturns are shorter but steeper. So the even visual shape of a static cycle is not what happens in the market. So you will always, or in most cases, expect that the top will come in more late, because that's the design of financial assets right now, and the low will come in more early as expected. That's the skew of cycles in financial markets, but that's another topic. So if we would move forward, so for example, we have been aware of the cycle tops, and somewhere in March, yeah, let's update our analysis here to March. So the markets have come down really a lot at this point in time here. So this is the data. So our cycle analysis again showed that the cycle with a length of 172 is active, but now we always also adjust to the phase of the cycle. Yeah, it's the length, the phase, and the amplitude, which is important. We can skip amplitude here for price projections, but phase is important for timing. So let's update our analysis here with the 122. And you see here that we still expect here that the cycle low has been, yeah, forecasted coming in beginning of May this time here. So let's add the data how this happened. Not only that, you also see that the top was then projected here. And last but not least, no, I will not add the skew here. I will not go too much into the details here. The only reason I added this into the mix for our today's session is that the cycle of a length of 170 days or something is a cycle which has been in the past very, very active in detecting major market tops and low, at least in the year of 2020. In the year of 2021, I mean, we just have a straight up move since then. So no cyclic behavior is visible in the market. But, and that's the closing sentence for today, now the daily cycle with a length of 170, the weekly cycles come into alignment, projecting a major top timing-wise. Adding the analysis of Peter Eliades, which has some price projections where we could turn, which we are very close to, you now have two cycle analysis, timing analysis, price projection analysis, both based on the Hurst ideas, getting into alignment. And I would highly recommend do your own research on the timing of stock market cycles and the price projections. Head over to the analysis of Peter Eliades on the YouTube channel. It's there for free. So, and if you want to learn about his method of analyzing how it works, there is a free video on our financial summit we did last week. So I just want to highlight there is a financial summit last year with Jeffrey Hirsch and Peter Eliades. And in the second hour, there's a 1 hour session with Peter where he is explaining his method. It's also there. It was free last year. It's there on our channel. So you can dig into his method also more in detail to understand how he is doing these kind of analysis. That's the topic for today. So now we need to monitor the markets. I will now move over to your live questions. So I will just, don't get irritated if I move my head this way. I just see that you more or less at least like the analysis. So I hope it was loaded with some education so that you know about how to do some kind of analysis, why it's important also to add other methods into the mix. And our review, so we will monitor the markets, what happens. So this is live, this is current data. This is not showcasing, cherry picking something from the past. This is cyclic analysis in today's markets. As always, we will review similar topics next week, Monday, same place, same channel. Please like, please subscribe, please invite your friends. Let's grow the channel here. Let's push the idea of cycle analysis. Let's share the knowledge here together as a group. I'm always happy to receive your comments and questions. Thanks for joining me today and see you next week. Bye.